You may have heard that Chinese stocks have taken a beating this year. When I heard this, I assumed that Chinese stocks were down 10, 15, maybe 20%. But a couple of days ago, I checked out the graphs of the most popular Chinese stocks and I was blown away. Alibaba is down 50% since last October, Tencent is down 43% since last February, and JD.com is down 40% since February. It's not just individual companies either. The Nasdaq Golden Dragon China Index, for instance, is a compilation of the 98 biggest Chinese companies traded on US markets, and the entire index itself is down 52% since just February. This means that this is the largest crash experienced by Chinese stocks since the 2008 financial crisis. Meanwhile, if you're just looking at the American stock market, you wouldn't even know that such a crisis was going on, as the S&P 500 hasn't even pulled back 5% since last October. So, why are Chinese stocks getting massacred? The most obvious reason on the surface seems to be increasing American regulation. Since the beginning of the year, the US government has made their intent to crack down on Chinese stocks extremely clear. For instance, in March, the SEC adopted a new law called the Holding Foreign Companies Accountable Act. This law gives the SEC the power to delist foreign companies from the US stock market if they don't comply with auditing requirements. This isn't just specific to Chinese stocks, but Chinese stocks were obviously the biggest target. Aside from required auditing, the SEC mandated that Chinese companies must identify all of the CCP members that are on the boards of the companies. Now, you might be thinking that these regulations are a bit overboard, and that these policies are driven more by politics as opposed to an actual concern. While that is partially true, the threat of accounting fraud can't be completely dismissed. Luckin Coffee, for instance, was an up-and-coming Chinese coffee company similar to Starbucks. They had blowout after blowout earnings, but eventually, the SEC determined that it was too good to be true. Between April of 2019 and January of 2020, Luckin Coffee overstated their revenues by at least $300 million. This earned Luckin Coffee a $180 million fine, followed up by a delisting from the US stock market. This isn't a rare occurrence either. Almost every year, a Chinese startup will fudge their numbers and pull a quick one on American investors. While this is a shame, these companies aren't the real threat. In most cases, their frauds are easily visible to experts, and the companies themselves usually give in after they've made their money. The bigger companies like Alibaba and Tencent, however, are suspected to have much more elaborate schemes that can't be easily detected. As you would have guessed though, the Chinese have no intention of cooperating with American regulation. Instead, they've decided to fire back with their own regulation on US stocks. Until now, none of this has led to any serious action. But as tensions escalate, many investors have decided to get out before things actually get ugly. Aside from the delisting fears, China themselves have been cracking down on Chinese companies. This might sound a bit weird. If China themselves agreed that more regulation is needed against their own companies, why aren't they accepting American regulation? Wouldn't another set of eyes just improve the chances of catching something nefarious? Well, the thing to keep in mind is that China is a communist country, and they truly believe in socialist ideologies. In recent decades, they have allowed for a free market economy, as this is really the only way to stay up to speed with Western countries. Don't let this fool you though. The CCP is extremely keen on maintaining control over the market. And whenever they see Chinese companies and individuals overstep their bounds, the CCP will crack down. The CCP doesn't really care if Alibaba fudges numbers or performs insider trading or anything like that. And that's why they don't care about American regulation efforts. But they do care if Alibaba is threatening the power and control of the CCP. And over the past year, the CCP has determined that Chinese tech billionaires are indeed threatening their power. The biggest indication of this was likely Jack Ma's quote-unquote controversial speech late last year. In November of 2020, Jack Ma, the founder of Alibaba, made a speech in which he criticized the Chinese financial system. Jack was actually being extremely careful, and made sure to preface his critique by saying that he might be wrong, and that his words shouldn't be taken too seriously. The CCP, however, took it pretty seriously, and Jack Ma would disappear for 3 months. I think this was really the turning point. Jack's speech made it clear to the CCP that they give billionaires way too much freedom, and ever since, China has been working on showing who's truly in control. Ironically, this entails destroying their own companies to put them in their place. One example of this crackdown is Didi Global. Didi is basically the Chinese Uber, and they just went public in June at $14 per share. After Didi's IPO, the CCP straight up banned new users from downloading the app in China. There's also reports suggesting that the CCP is considering delisting Didi and encouraging citizens to use a state-owned ride-hailing service. This is actually hilarious. The CCP is like, Americans, don't worry about delisting our companies. We'll do it ourselves. As you would guess, Didi stock is down 54% since then. One Harvard professor is actually suggesting that the CCP wants the stock to crash. This way, rich CCP officials can buy up all the shares and take the company private at super low prices. In other scenarios, the CCP has banned the IPO itself, as is the case with Jack Ma's Ant Group. Aside from direct bans, the CCP has also swamped the top tech companies with a plethora of lawsuits and litigation. In April, the CCP hit Alibaba with a record $2.8 billion antitrust fine. They also dished out a $1.5 billion antitrust fine to Tencent. Regulators also gave other Chinese tech giants, including ByteDance, Baidu, and JD.com, a stern warning that they better watch what they're doing if they don't want to end up like Alibaba and Tencent. Anyway, the third factor driving down Chinese stock prices is China's economic policy. The Fed has been printing money like a madman, and this has been the same case around the world. Since the start of the pandemic, the US has released $5.2 trillion worth of fiscal stimulus, and it looks like the Fed is just starting to talk about tapering. In China, however, they aren't just talking about it, they're already doing it. In fact, they started tapering their bond sales at the beginning of the year. This might not sound like a big deal. Tapering technically does mean that the economy is recovering well and that government stimulus is no longer needed. Nonetheless, the market likes to throw a tantrum every time monetary policy is tightened, despite how obvious or transparent the tightening was. And that brings us into the next factor killing Chinese stocks, and that's extreme valuations. If you've been following the American stock market, you would know that stocks have recently been unstoppable. Stocks are arguably overvalued and even in bubble territory according to many of the most respected fundamental indicators. The Shiller PE ratio suggests that we're above Great Depression levels and nearly at dot-com levels. Similarly, the Buffett indicator suggests that we are strongly overvalued right now, with the stock market boasting a value that's 138% higher than the US GDP. And if you think US stocks are out of control, you haven't taken a look at Chinese stocks. During the pandemic, the S&P 500 first dropped a little over 30%, before rallying 92% within just 18 months. Meanwhile, the Nasdaq Golden Dragon China Index only dropped 23%, before rallying 141% within just 12 months. Keep in mind that markets generally only grow 8% per year. So all of these numbers are unprecedented. With that being said, it was just a matter of time until something pushed these valuations over the edge and back down to reality. And that brings me into the biggest factor pushing down Chinese stocks, and that's market manipulation. Everything we've outlined so far is absolutely valid, and something you should definitely consider if you're going to invest into Chinese stocks. At the end of the day though, there's only one group that controls the big movements within the stock market, and that's smart money. This includes the big market makers and hedge funds in the US, as well as the big financial institutions in China along with the CCP. I wouldn't exactly say that these guys are smart, but they do have a crap ton of money, meaning that they can move markets. Concerns regarding Chinese accounting and delisting tensions aren't anything new. Cracking down on the Chinese was one of Trump's biggest campaign promises way back in 2015 and 2016. Yet, the market did not care up until this year. This does not mean that the concerns are invalid, but rather that the concerns only matter when smart money says it matters. Here's the thing, the big players need liquidity to actually get in and get out of the market. If they're selling $100 billion worth of stocks, they need someone to buy $100 billion worth of stocks and vice versa. And the way they get a bunch of people to take the other side of the trade is by creating extreme sentiments in the market. For instance, they might run up stocks beyond belief just like they did last year. An index moving 141% within 12 months is ludicrous. And the only reason that happened is because smart money was trying to bait retail investors into Chinese stocks by creating FOMO, or the fear of missing out. But just as all the retailers bought in, smart money used the increased interest to offload all of their positions. Similarly, as everyone sells their positions, Smart money uses the increased fear to buy the crash. Does that mean that you should buy right now? Not necessarily. Just because the Nasdaq Golden Dragon China Index is down 50% does not mean that this is the bottom. In the dot-com crash, the US Nasdaq 100 crashed 84% before bottoming out. Study after study has shown that it's basically impossible to time the market, unless of course you're smart money or have insider knowledge. But the bottom line is that smart money decided at the start of this year that it was time to get out, and they used delisting fears and US-China tensions to stage their exit. We might have seen some more support if the CCP was interested in keeping stocks high, but they were also on board with killing valuations to teach the billionaires a lesson. And this created the perfect storm that massacred US-listed Chinese stocks. Were you guys aware of this massive bear market in the background? Comment that down below. Also, drop a like if you can't wait to see American stocks finally cool down as well. And of course, consider joining our Discord community to suggest future video ideas and consider subscribing to see more questions logically answered. But until then, I'm Hari, and I'll see you guys on the next one.